Welcome to the deep dive. We're here to really unpack complex topics, pull out those essential insights from the source material, and basically help you quickly grasp what truly matters. Today, we're diving deep into, well, a pretty intriguing set of financial analyses and investor notes. They're all focused on one company, Amplify Energy, ticker symbol AMPY.
Right. And our mission today really is to figure out why this particular small cap energy producer is getting called, and this is a quote, the energy market's most overlooked upside story.
Hmm.
Especially, right now when a lot of investors are kind of shying away from smaller oil stocks.
Yeah, and here's where it gets really interesting, I think. There's this disconnect. Wall Street might be writing off these small exploration and production EMP companies saying they're too risky, but the insiders, the people at Amplify Energy, they're doing the complete opposite.
They're buying heavily.
Yeah, exactly. So we're going to explore why this company, which is currently trading at, well, a fraction of its estimated value, might actually present a compelling case for you. Okay, let's start by unpacking this core idea from the sources. Amplify Energy is immediately flagged as a, quote, deep value play. What does that actually mean, especially when, most investors in energy seem fixated on scale or maybe aggressive growth or just high dividends right now?
Yeah, deep value, it basically means you're looking at a company price significantly below what its underlying assets or its earnings power suggest it's truly worth. It's fundamentally cheap. So unlike, say, growth stocks, which are all about future potential, deep value is about finding these hidden bargains. Companies the market is maybe ignoring or just misunderstanding at the moment. And Amplify Energy, NYSE ticker AMPY, it seemed to fit this description perfectly based on the analysis. It's described as lean, focused on free cash flow. It's got diversified U.S. assets and a management team that seems laser-focused on creating value, not just, growing for growth's sake. And the core argument for it being undervalued, it really comes down to its low multiple metrics.
Low multiples. Okay, so give us the key numbers then. What figures really highlight this low multiple value and show that disconnect you mentioned?
Absolutely. So the company trades at an EV/EBITDA of just 3.4x.
Okay, 3.4. Remind us quickly. EV/EBITDA.
Right. Enterprise value to earnings before interest, taxes, depreciation, and amortization. It's a key metric, basically shows how cheaply the company is valued relative to its core operational cash flow. And 3.4x, that's exceptionally low, especially when you compare it to its peer median, which is hovering around, say, 3.5 to 4.0x.
So it's already below the average there.
Significantly. And maybe even more strikingly, its price-book ratio is 0.33x.
0.33? Wow.
Yeah. Price-book compares the market value to the book value, basically the value of its assets on the balance sheet. So at 0.33x, compared to a peer median around 0.5x, it makes Amplify one of the absolute cheapest oil stocks trading right now, even cheaper than some companies that are considered, distressed.
So it's dirt cheap on paper. It's like, I don't know, like finding a designer watch at a thrift store price. But does that mean there's a real margin of safety for you, the listener? Does this analysis suggest the downside risk is actually limited?
That's exactly where this valuation disconnect becomes, well, crystal clear. The share price is hovering around, $3.20 currently. Yeah. The source material suggests it's trading at less than half its estimated intrinsic value.
Less than half. Okay.
Yeah. And things like discounted cash flow analysis, DCF, where you project future cash flows and discount them back.
Right. Standard valuation method.
Exactly. That points to a base case equity value somewhere between $6.50 and $7 per share. And that's using pretty robust free cash flow projections and fairly conservative assumptions, too.
Okay. So the base case is already double the current price. What about that downside protection you mentioned? What does the worst case scenario look like here?
Well, even if you run a bear case scenario, let's say oil prices dip into the low $60, maybe production declines a bit. The analysis suggests the stock's valuation floor is probably somewhere around $3 to $4 per share.
Which is pretty much where it's trading now.
Exactly. So it suggests that a lot of the potential risk, maybe most of it, is already priced into the stock. That gives you that margin of safety we talked about.
Right. And on the flip side, then, what's the potential upside look like if things go well?
The bull case. Well, in that scenario, maybe oil prices hit $75 or higher. Production from their key beta field improves. Amplify's equity could realistically reach $9 to $10 per share.
$9 to $10.
Yep. And that aligns pretty well with the company's own PV10 valuation. They put that at $518 million, assuming 65 oil and $4 gas.
And PV10 is...
Sorry. It's the present value of the future net revenues you expect from a company's proved oil and gas reserves, discounted at 10%. It's a standardized way to measure the value of those underground assets.
Got it. So significant potential there.
Absolutely. Even the base case, remember, suggests potentially 100% upside from where it is now,
Yeah.
which, it really begs the question. If the numbers look this compelling, why is the market apparently overlooking this?
That is the key question, isn't it? And maybe that leads us nicely into the next point. You mentioned Amplify as free cash flow focused. How does their sort of operational discipline back that up, especially when oil prices are so famously volatile?
Right. Their strategy isn't about just drilling more wells and chasing production growth like some companies do. It seems singularly focused on maximizing that free cash flow. For example, for 2025, they've actually trimmed their capital expenditure, their CapEx, money spent on equipment and new projects.
Hmm.
They've cut it down to a range of $55–70 million.
Yeah.
That's down from an earlier projection of $70–80 million. And the reason given, specifically to preserve capital.
Okay, that sounds fiscally responsible, tightening the belt. But how does that actually translate into their cash flow projections? If they're spending less, are they still generating cash?
Well, yeah. Despite some, let's call them short-term headwinds, like they had a free cash flow shortfall in Q1
Right.
because some spending was front-loaded,
Okay.
they still project full-year free cash flow of $10–20 million for 2025. And that's after paying interest. So it shows the discipline is paying off in terms of expected cash generation.
That is pretty impressive, especially for a smaller company prioritizing value over just chasing growth numbers, which you see a lot in this sector. Tell us a bit more about their key assets then. Where is this value coming from?
Well, the analysis really highlights their beta field development.
Mhm.
It's often called their crown jewel. And the reason is it boasts these really high internal rates of return, IRR. That's the annual rate of growth an investment is expected to generate. At the beta field, the IRR is apparently exceeding 90%, even if oil is only at $60 a barrel.
90%. Wow.
Yeah, really strong economics. But here's what's fascinating and speaks to their discipline. Even these super high IRR well programs, they've actually been deferred, pushed back.
Deferred. Wait, why would they defer projects with 90% returns? Doesn't that seem counterintuitive?
It does at first glance, right?
Yeah.
But the analysis suggests this isn't a sign of weakness or that they can't afford it. It's seen as providing strategic flexibility. They're holding off without sacrificing the long-term economics of those wells. It really demonstrates that commitment to cash flow discipline right now over just boosting production immediately. They control the timing.
So it's not just about being cheap, it's about having a sound, disciplined strategy behind it. But, playing devil's advocate. Couldn't a cautious investor see that deferral differently? Like maybe it signals a lack of confidence in the future, or worse, maybe they can't actually fund those projects right now, adding to the market skepticism.
That's a totally fair point, and it probably speaks to why the market is skeptical, given its current bias towards immediate growth. However, the argument is that their consistent cash flow projections and the sort of strategic nature of how they're deploying capital suggests these deferrals are more about optimizing returns and preserving capital until the time is right.
Waiting for the opportune moment, maybe.
Exactly. Perhaps waiting for higher oil prices or just a generally better market environment to deploy that capital for maximum impact. So the idea is that this ongoing discipline should hopefully address that skepticism over time.
Okay, that makes sense. And that discipline, combined with the valuation, it brings us to maybe the most compelling evidence supporting this whole thesis, something that often speaks louder than analyst reports. Insider activity. What are the insiders, the people who supposedly know this company best, actually doing with their own money?
Yeah, this is where it gets pretty striking. The sheer conviction shown by those closest to the company is notable. Over just the past 6 months, insiders have bought over $1.15 million worth of shares.
Over $1 million.
Yes. And critically, during that same period, there has not been a single recorded insider sale. 0 sales.
Wow. That's not just pocket change. That's a substantial financial commitment. Can you give us some specific examples of who's been buying?
Absolutely. The biggest move was quite recent, actually, in early June. A director, Clint Coghill, acquired 304,000 shares for around $1 million.
1 million by one director.
Yep, including a single-day purchase of 181,000 shares. Now, these were technically indirect buys through his firm, Stony Lonesome,
Ah.
which now owns about 7% of Amplify's total shares. So, a significant stake.
Okay, so one big buyer. Was it just him, or was this a broader vote of confidence from the leadership team?
No, it seems like a pretty coordinated effort, or at least widespread conviction. You had another director, Todd Snyder, buying 25,000 shares around $3.83. The CEO, Martin Wilshire, and the CFO, James Frew, They each bought 15,000 shares right around $3.85.
Okay.
Then Director Deborah Adams picked up 10,000 shares a bit higher at $4.14. And another officer, Daniel Furby, bought 10,000 shares lower down at $2.97 back in late May.
Interesting. Buying at different price points, too.
Exactly. That kind of varied buying across different executives and directors and at different price levels. It really reflects a deep shared belief that the company is undervalued and that the long-term strategy is sound. Your research from places like Waker.ai, which analyzes insider activity, apparently confirms that this level of broad insider buying is often a marker of what they call extreme undervaluation.
Extreme undervaluation. Okay, so we've got the low valuation metrics, we've got the operational discipline focusing on cash flow, and now this really strong insider buying signal. But let's talk about the other side. What does this all mean when we consider the inherent risks? Any small cap energy producer carries risks. The market isn't entirely irrational, right? There must be reasons for this discount.
You're absolutely right, and it's important to acknowledge that. Amplify's discount isn't completely without explanation. There are concerns. Things like the company's relatively small scale compared to larger players, the fact that some of its assets are mature, and importantly, those legacy environmental liabilities, specifically the oil spill back in 2021.
Right, the California spill.
Exactly. Those are valid points, and the market has clearly factored them into the current low valuation.
Okay, so the market has its reasons, its rationalizations for the price. But the analysis you reviewed suggested these risks might be, quote, overstated. Why? Why does the analysis think the market's assessment might be overly pessimistic here?
Well, the argument hinges on management's clear capital discipline, those strong cash flow metrics we discussed, and the underlying stability they've shown in production, even with mature assets. These factors suggest that maybe the risks, while real, aren't quite as dire as the current stock price might imply. What's crucial is the idea that the current valuation already reflects these concerns. And arguably, perhaps even more than reflects them. The discount might be too deep.
So the risks are baked in, maybe overbaked. If that's the case, what could be the catalyst? What could actually help the market re-rate Amplify Energy and make investors recognize this potential hidden value?
Good question. If we try to connect the dots here, the analysis points to maybe 4 key potential catalysts down the road.
Okay.
First is continued strong operational performance, and importantly, the eventual resumption of drilling at that high-return beta field that could significantly boost production and cash flow visibility.
Makes sense.
Second, even just a moderate recovery in oil prices. Because of their operational setup, they have pretty significant leverage to commodity prices. So even a small bump in oil could dramatically improve their valuation math.
Right. Leverage works both ways. What else?
Third, M&A activity. Amplify could become a strategic target for consolidation. Someone might want to buy them given their attractive metrics and relatively clean balance sheet now. Or they could be the ones doing accretive acquisitions.
Interesting. And fourth.
And finally, just a broader shift in market sentiment. Right now, big is beautiful in energy. If sentiment shifts back towards valuing smaller, disciplined E&Ps, that could drive substantial upside just by bringing Amplify's valuation closer to or even above its peer averages. It raises a bigger question for all of us, really. Are other sectors maybe overlooking similar opportunities because of these kinds of short-term market biases?
That is a really powerful thought to leave our listeners with as we wrap this up. Okay, so to summarize this deep dive, Amplify Energy seems to offer this rare setup. You've got asymmetric upside potential.
The potential gain looks much larger than the potential loss based on current levels.
Right. Plus, clear operational leverage to oil and gas prices, and this disciplined approach to capital deployment. Well, the risks are definitely there.
They are.
The current valuation seems to already account for them, maybe even excessively so.
Yeah, exactly. For listeners who are looking beyond maybe the mainstream energy giants, the analysis presents Amplify as a kind of small cap outlier with big cap metrics, a potential hidden gem in today's energy sector.
So we've dug deep into the specifics of Amplify Energy today, but here's that final thought for you, the listener, to really mull over. Considering how focused the market currently is on sheer scale and rapid growth, what other overlooked value might be hiding in plain sight, maybe in completely different sectors? Especially if you apply the same deep dive lens looking hard at valuation, at cash flow discipline, and for that strong insider conviction. Keep digging.